Hi everyone, very good evening. I hope you all are doing well. Welcome back to this session. So recently the Monetary Policy Committee meeting has concluded and we have the governor's statement and all the important decisions taken in that meeting out. So we are going to discuss all these decisions in much detail today in this class, right? So I will be focusing upon the decisions taken, the effects as well as the concepts to make you understand whatever has happened, right? So stay tuned in this class. Let's begin. These are the MPC meeting key highlights, 6th December 2024. If you look at the much awaited thing, whenever there is an MPC meeting, the much awaited thing is the repo rate, right? Whether there is a change in the repo rate, which is also known as the key policy rate or not. So the repo rate has been kept unchanged. Remember, this is the highlight. Repo rate has been kept unchanged. Okay, just a second. Yeah, the repo rate tends to be unchanged at 6.5%. So if you remember, in the last MPC meeting, the repo rate was again unchanged at 6.5 only. Now, before moving ahead with the further decisions taken in this meeting, I would like to discuss the static portion of the MPC, right? Before going on to the key highlights, what is MPC basically? MPC is the Monetary Policy Committee. MPC stands for Monetary Policy Committee. Now, what is the work of Monetary Policy Committee? I hope you all must be knowing the static portion, like which section of the RBI Act the MPC is created, right? So MPC's broad purpose, if you look at, it has been created to track the inflation trajectory of India. Also, it recommends the decisions regarding repo rate changes, right? So it provides you the basic benchmark interest rate or the key policy rate changes. Also, it does the GDP growth forecast for you, whether cutting down the GDP growth forecast or say increasing the GDP forecast for the country. MPC, the Monetary Policy Committee, is basically a 6-member committee, remember, right? It is a 6-member committee. 6 members chaired by RBI Governor. 3 members are from the central bank, including the RBI Governor, and 3 members are from the government side. So it has representation from both of the sides, the central bank as well as the government side. The MPC has to meet at least 4 times a year or once in a quarter. You can remember that. Okay, these are important facts. Please remember, MPC has to meet at least 4 times a year or at least 1 time in a quarter and then decide. The quorum of the MPC meetings is 4. What is quorum? Quorum is basically minimum number of members to be available to start the meeting or to have important decisions, right? So the quorum is 4 members. At least 4 members need to be present. And remember, in MPC meeting, the RBI governor does not has a veto power. RBI governor has a casting vote. Now, what is the difference? This is again very important point. The governor does not has a veto power. Governor has a casting vote. That means in case of a tie, suppose 3 members and 3 members, right? So 6 members are there. If there is a tie on some decision, in case of that tie, RBI governor's vote, whichever side it goes to, will be considered, that decision will be considered as final. So these were certain important facts regarding MPC. I hope they are very much clear to all of you. Let's begin now with the key highlights. So first thing, as I have discussed already with you, is the repo rate remaining unchanged at 6.5%. What is repo rate? You all must be knowing repo stands for repurchase option. It is also known as the key policy rate. Now why? What is the rationale? Why they have kept the repo rate unchanged? See, they have kept the repo rate unchanged because of high inflationary expectations, right? Repo rate, whenever is higher, it is kept higher to contain the inflation. And you know, the main objective of monetary policy is to maintain the inflationary levels within the desirable brackets. What is the desirable bracket presently which India has adopted is 4 plus minus 2%, right? 4 plus minus 2%. Within this range, we need to maintain inflation. For that, RBI has a lot of quantitative tools which it does the changes accordingly. So, repo rate has again been kept unchanged at 6.5, which is higher, and it is a continuing legacy of tightening of the money supply, tight monetary policy. Why? Because you see, they want to contain inflation. They are expecting, yes, they are expecting food inflation basically to be higher. The governor's statement has clearly highlighted that we are expecting, due to climate change, in the last meeting as well they have highlighted this thing, remember, due to climate change, there are uncertainties in agricultural productivity. Supply chain disruptions can be there due to erratic patterns of rainfall, etc. That supply chain disruption can reduce the availability of agricultural produce, which can further increase the food inflation. So, in expectation of all these future inflation projections, the repo rate has been kept unchanged. I hope this is clear, right? It stands at 6.5%. And what is repo? You all must be knowing it is the rate at which the commercial banks, the basic definition if you see, the rate at which the commercial banks they borrow from the RBI. So basically it is not like an interest rate you have charged and then you have gave the loan. No, the operation is the commercial banks or other eligible entities, financial entities who can borrow under repo window from RBI, they need to keep government securities as the collateral with an agreement to repurchase it, and RBI charges an interest, that is the repo rate. Simple, right? So this is an agreement to repurchase the government securities. That is why it is known as repo, repurchase option. And that's why in bookish language, if you see, they define it like RBI giving loan to the commercial banks, and that interest rate, they call it as repo. But the operational language, if you see, is giving government securities or placing government securities as collateral with an agreement to repurchase them. This is the basic thing. I hope it is clear. That's why the name repurchase option, right? So this is 6.5. Now if you see the other rates, because I have told you, you only need to remember the repo, not the other rates, right? Why? Because the other rates are already related to the repo. So if you see the standing deposit facility rate, it will always be 0.25%, 0.25% less than the repo rate. Less than the repo rate. Why? Okay, one more very important fact regarding the SDFR. You should remember this. The standing deposit facility rate, 6.25. It also remains unchanged. This SDFR, it has replaced the erstwhile reverse rate repo, okay, as the floor of the LAF, liquidity adjustment facility. So basically, if you see the liquidity adjustment facility under which RBI manages the system liquidity via the MSF and the, okay, tell me, what is the floor, or say what are the higher and lower limits of the LAF? This is the question to all of you. You will tell me in the comment section what is LAF and what is the higher and lower limits of the LAF window, right? So the RRR used to be there, the reverse repo rate, okay, triple R. It has now been replaced by SDFR, standing deposit facility rate, which is uncollateralized. Remember that, which is uncollateralized. So if you have excess surplus, right, you can park them with RBI, but you don't get any collateral against that, right? So RBI offers you an interest on that. RBI offers you an interest on that, and that is SDFR. It has to be lower than what it charges you, right? This is how a bank works. The interest rate which is being charged will always be higher than what has been provided on the deposits. So SDFR has replaced RRR as the floor of the LAF window. I hope it is clear now. Then if you see MSF, marginal standing facility, which is the overnight borrowing facility for the commercial banks and other eligible entities, you can borrow overnight, right? Also stands to be 6.75. Now remember, MSF will always be 0.25% higher than the repo rate. So 6.5 plus 0.25, 6.75. Then you have bank rate, again 0.25% higher than the repo rate. So these are the policy rates. Now moving on to the next changes. Reason I have already discussed with you why repo rate has been kept higher is inflation. Okay. Inflation, the governor's statement has clearly stated, inflation has surged above the upper tolerance band. What is the tolerance band? 4 plus minus 2%. So the upper tolerance band has to be 6%, but then it has crossed already the upper tolerance band of 6%. Now, since inflation has crossed the upper tolerance band of 6%, it is very important that these rates are kept higher. Are you getting my point? So as to contain the liquidity in the market. But then we have CRR again been cut down. This is to inject system liquidity. This is to inject system liquidity, okay, in the market. So just give me a second. All right, I hope it is clear, everyone. So that's why you see repo rate has been kept unchanged because inflation has been higher, and in future they are expecting that it is going to be high due to food inflationary pressure. Why didn't they still increase the rates, madam, to control inflation? See, one thing, you cannot go increasing the rate beyond a certain level. This is again a very good question. They have maintained the repo rate unchanged along with the stance, making it neutral. What happens is they have to strike a balance between growth as well as the containment of inflation. Are you getting my point? They cannot only focus on containment of inflation and they cannot only focus on growth. Right? So see, if they keep on increasing repo, what happens is lending activities they reduce in the market. Right? When repo increases, the repo rate based lending rate, RRLR, and then the MCLR, because whenever repo increases, that decision has to be transmitted, what we call as monetary transmission via the banking system. So just one example I'll give you to make this point clear, not in much detail. Suppose repo rate has increased. Now for banks, borrowing from the RBI has become costlier, isn't it? They will make this costlier for you as well because they have to recover that thing. For them, paying the interest to RBI is also a cost. They will make your cost of borrowing higher because that is monetary decision has to be transmitted to the economy via monetary transmission. So the cost of borrowing for the consumers also increases. In that case, if there is no borrowing, investment activities will get reduced, and once investment gets hurt, you don't have production in the economy. If there is no production, there is no economic growth, then what is the point of containing inflation? The broader aim of containing inflation was to align it with the objective of growth. That's why they cannot go on increasing the repo rate. It can hurt the market sentiment actually. Right? I'm coming to the CRR point as well. We will discuss CRR as well. This is the broad understanding. Then food inflation pressures, they are likely to linger in quarter 3. They are expecting food inflation to be higher in quarter 3 as well of this financial year. Okay. But there can be some seasonal corrections in the vegetable prices, Kharif harvest arrivals, good Rabi output and adequate cereal buffer stocks. See, presently Rabi season is going on, right? The winter crops. So if the Rabi crops, they are good, they are harvested in good amount, then inflation can be moderate. But since it is only expectation, so the time will tell what the inflation would be. In that case, the next monetary committee meeting would be deciding on the repo rate. As of now, they are expecting it to be on a higher front. I hope it is clear, right? Moving on to the next slide. Now, very important, they have made the stance unchanged as well. The stance of the Monetary Policy Committee remains unchanged at neutral, right? So before this as well, they have kept it unchanged. They have actually changed it to neutral. Before that, it was withdrawal of accommodation because inflation was so higher. So in the last MPC meeting, if you remember, I think 9th October it was concluded, right? So 9th October MPC highlights may we have discussed that there is a change in stance to neutral. Now it has been remained unchanged again to neutral. But before neutral, it was withdrawal of accommodation. That means they want to withdraw the accommodative policy. What was the accommodative policy? Increasing the supply. Now they want to contain the liquidity in the market, right? That's why adopted neutral stance. Now what is this neutral stance? Neutral stance is we will be containing inflation, but we are not only concerned with containing inflation. We are also concerned with proper economic growth. That's why you see repo rate has been kept unchanged, CRR has been cut down. So the stance is not withdrawal of accommodation, the stance is neutral. That's why these kind of decisions have been taken. Neutral stance clearly states alignment of these two targets, alignment of inflation containment as well as the economic growth targets. I hope it is clear, everyone. So stance has been neutral, unchanged from the previous decision, right? To remain unambiguously focused on a durable alignment of inflation with the inflation target along with the growth, as I have told you. Everyone, is it clear? Do you have any doubt so far whatever I have discussed with you? You can ask me, otherwise I will proceed because these are very important decisions, you know. Clear? Very good. Next thing. Now let's see whatever growth and inflation assessment they have done in the meeting. They have stated what is the performance of global as well as domestic growth and inflation and what are their projections, which are very important figures for all the upcoming examinations. So first thing, assessment. If we talk about the global economy, so the MPC has stated that global economy has shown unusual resilience in 2024 despite several headwinds. Several say reasons like geopolitical tensions, Russia-Ukraine war, disruption of supply, lot of factors, right? Despite that, rising global debt, despite all these reasons, global growth has been unusually resilient. So that is a good indicator, right? Then, how do we say that? Do you have any figure to substantiate? Yes. So the MPC has quoted these two figures. I think they are very important. That's why I've chosen them in this, selected them this for PPT. Remember, the OECD, Organization for Economic Cooperation and Development. So OECD in its December 2024 recent outlook has retained GDP growth forecast for 2024, the global one, okay, at 3.2%. And the IMF has also retained the growth projection in its latest October edition of the the famous World Economic Outlook report at 3.2%. So I want you to remember these two global growth projections, 3.2% by two of the most important international organizations, and OECD and IMF data has been again and again asked in your examinations, right? So please remember global projection for 24, 3.2%. Okay, remember that. And then global trade, if we talk about, has remained resilient. That's why the global growth is also resilient. Global trade has remained resilient. It is also booming, but there are tendencies of protectionism. So the governor's statement has highlighted this thing, and MPC has highlighted this thing, that although global trade is resilient, but there are certain tendencies of protectionism in global trade. What is this protectionism? If you have been recently following my CA classes, you all know that we have news like European Union want to charge the carbon intensive product with higher import duties. Yes or no? Tell me. Yes, right? Recently there was this news that USA has warned BRICS countries that it will be charging 100% of import duty. Due to some conflicts, these kind of statements are out there. Are you following up with me? Have you heard these things, right? So this is kind of a protectionist trade policy. countries are trying to protect their boundaries. Why? To make their domestic producers survive and boom. So this kind of protectionist tendency can hurt the global development. But as of now, global trade is resilient. This is the status highlighted by MPC. All clear, right? So this is the thing. Global trade remains resilient, but there are tendencies of protectionism which have a potential to undermine this global growth and push the inflation higher. Because global growth can be undermined with these kind of decisions, and once you close your boundaries, whatever gets produced in your economy has to be consumed, right? Also, if it is a kind of protectionist trade policy you are adopting, then it hurts the supply chain. It hurts the adequate supply. Once supply gets blocked, it leads to cost push inflation, or it leads to bottleneck inflation, supply side inflation, right? So that is the looming risk which has been highlighted by MPC. Then next slide, GDP growth projection. These are very, very important figures. Very, very important figures. Okay. Now, one thing, real GDP growth, if you see, real GDP for which the prices are taken from the base year. Presently, the base year is 2011-12. But the news is, yesterday only we have covered that it is going to be revised to 22-23 with effect from April 2026, right? So still presently the base year for real GDP, the prices which we take from the base year is still 2011-12. Now this real GDP growth for 2024-25 is projected at 6.6%. This is very important figure. Please remember this. I hope you understand the difference between real and nominal GDP. Real GDP mein prices. So how do we calculate GDP? GDP is basically P into Q. GDP is what? Total market value of all the final goods and services produced within your domestic territory by the factors of production during an accounting year, right? This is the thing. Now these prices, to calculate the market value of all whatever it has been produced, prices for real GDP are taken from a base year, which is presently 2011-12. But in nominal GDP, it is the current year prices, the accounting year prices only, not the base year. This is the basic difference. So nominal GDP reflects the inflation impact, or it is not adjusted for inflation. It will include the impact of inflation on GDP. So nominal GDP figures can be misleading. This is the hint I am giving you. Are you getting my point, everyone? Right? Nominal GDP figures can be misleading. It can be higher due to high prices, not rise in the production, or can be higher due to high production. Both cases can be there. But real GDP is only higher when the quantity increases because price is fixed. It is of the base year. This is the basic difference between real and nominal GDP. Did you get this point, everyone? Right? This is the thing. So remember, 6.6% is the real GDP forecast by MPC for 2004-05 fiscal year. Remember this figure, 6.6. It is important for all the upcoming examinations. Also, further forecast, if you see, for quarter 3, it is 6.8. Quarter 4, it is 7.2, right? These are the other figures. Then growth in real GDP in quarter 2. So this is the projection, what they are expecting. But the previous growth, the trend which they have highlighted, which they have analyzed, is saying that the previous growth is not so satisfactory. They are concerned with the previous growth trend. It has not been satisfactory. They have clearly stated that the growth in the real GDP in quarter 2 was at 5.4% only, which was not sufficient, right? Only 5.4%, which is much lower than what has been anticipated. Are you getting my point? So they have clearly stated the sectoral distribution of this. What sectors have led to decline in this real GDP growth for quarter 2 of this year? Why this decline has been there? So they have mentioned there has been substantial deceleration in industrial growth. If you look at the industrial sector's growth, it has declined. So industrial output has declined from 7.4% to 2.1%. That is a substantial decline indeed. That has contributed to fall in the real GDP growth in quarter 2. And which industries particularly have performed very bad in this thing? So if you see, it is due to subdued performance of the manufacturing companies plus mining activity plus lower electricity demand. So mining activity has witnessed decline, electricity demand has witnessed decline. So it is decline in the energy sector or electricity demand plus decline in the manufacturing companies. These have been the broader reasons highlighted by MPC. Then weakness in the manufacturing sector, if you see, because manufacturing sector is a broader term, right? Particularly which kind of industries in the manufacturing sector have witnessed this decline? It is specifically associated with sectors like petroleum products, iron and steel, and the cement. Iron and steel and the cement industry. Because iron and steel, cement and petroleum, these are the big shot industries. They create the backbone for economic development. Agree or not, right? If they decline, the entire production or real GDP growth has to decline anyway. So these were the assessment of growth performance and the growth projection 6.6. Remember, what is the inflation projection by them? Inflation projection, they are anticipating it to be at 4.8% for 24-25. And remember, it is CPI based inflation, the consumer price index based inflation, right? Remember this thing, that for inflation targeting as well, CPI based inflation is taken into reference by RBI. Now WPI based inflation is not taken as a reference for inflation targeting in India. I hope you have understood this point, right? This has to be very clear to you. CPI based inflation is now the reference for inflation targeting or inflation framework by RBI. So the CPI based inflation 24-25 is projected at 4.8%. With quarter 3 ka inflation, they are expecting at 5.7%. So see, the expectation of inflation or the projection of inflation is gradually increasing, isn't it? That's why repo rate has been kept unchanged. They are expecting a higher level of inflation in future due to food prices particularly. This is the thing. I hope it is clear. So 4.8% is the projection, overall projection for 24-25, and then in later on quarters, it is 5.7, 4.5, etc. Then if we talk about the liquidity and financial market conditions, liquidity in the system and other financial market conditions, first point, liquidity in the banking system, it has remained adequate. MPC is mentioning that the liquidity in the banking system or the systemic liquidity has been adequate. So no liquidity crisis looming upon the banking system. First thing. Okay. But there are certain things which in future can create a fall in the liquidity or a shortfall in the liquidity, systemic liquidity. What are these? So they have specifically mentioned that in coming months, due to more tax outflows from the banks, more tax outflows which you have to, the part of the operational income which goes into the taxes, right? More of tax outflows, then increase in currency in circulation. Currency in circulation increases, and then the volatility in capital flows. These can be certain factors which can create tightening system liquidity. So say money in circulation increases, the money in circulation say goes out from the banking system. Whatever coin currencies you have, it goes out from the banking system, circulates in the economy, right? What about the systemic liquidity? More of tax you have to pay out of your operational income, more tax outflows or outgo of taxes can create a shortfall of liquidity for the banking system. Yes or no? Are you getting my points, right? Plus, volatility in the capital flows. Why? Because you see recently there have been cases of capital outflow from the emerging nations and from India as well. What is capital outflow? So, for example, you have seen this thing, whenever the US's central bank, the Fed Reserve, increases the key policy rate, you witness a lot of capital outflow from emerging market countries and also from India. Because interest rates, they are not only the interest rate which we think as, cost of borrowing, but they are also the incentives which you get, or your return into investments, or your return from the investments you have done, right? So when these interest rates, they increase, it becomes attractive for the investors to invest in such destinations. Now such destinations, they become lucrative, and investors, they pull out their money from the other countries where they have invested earlier, and then that leads to capital outflow from that country. Are you getting my point, everyone? Right? So this volatility keeps on changing. Sometimes you have more of capital inflow, sometimes you have more of capital outflow. These can be reasons that there can be pressure on the systemic liquidity. That's why CRR has been reduced by 50 basis points, so that banking system has enough liquidity. Because if you want to withstand any crisis, okay, I don't remember exactly the year in which this work has been awarded with the Nobel Prize for Economics, but I think 2-3 years back, the Nobel Prize for Economics went for this work of highlighting the role of saving and investment in development of the economy. In that paper only, they have highlighted how much bank systemic liquidity is important. If your banks or banking system is liquid enough, you can withstand any economic or financial crisis. So that has to be there. That's why they have reduced the CRR to provide alternative, or so say to provide adequate sources of liquidity to the banking system, and then at the same time containing the inflation and providing relief to the rising price levels, right? This is the thing. If we talk about the rupee appreciation, the Indian national rupee status, so during 24-25 April-November time period, Indian rupee has depreciated by 1.3%. So there has been depreciation of Indian rupee. Why? Because dollar's demand was higher. Okay, so remember 1.3% say it has depreciated due to pressures from strengthening US dollar. Now US dollar strengthens due to a lot of reason. So you want to invest in some other countries, you require dollars. Our imports are higher. We have a trade deficit, right? And dollar is the most acceptable currency in international trade. Now when we import, we need to pay them into dollars. So there are several reasons that's why when your BOP or you have current account deficit, you have trade deficit, that is harmful, because then your currency also loses its value. Are you getting my point? Right? So we need more dollars. That's why it is in demand. A lot of reasons are there. So rising demand of dollar has exerted pressure on Indian national rupee. Also, the strengthening of US dollar and selling pressure by foreign portfolio investors in October and November has done this. You see, the FPIs, foreign portfolio investors. Who are FPIs? These are investors who invest not directly in the, say, companies, but they invest via these financial securities, portfolio investors. They invest via portfolios, right? So they invest via your stock market, your share market, via your financial securities. Now, this investment activity also leads to appreciation and depreciation of the currency. If they are investing in, say, dollar-based securities, the demand of dollar would be higher. Other currencies would see a pressure exerting on their currencies and then a depreciation. That is what happened with Indian rupee as well. I hope it is clear, right? So this is about liquidity and financial market condition. Then cut down on CRR, the cash reserve ratio. Cash reserve ratio. Cash reserve ratio has been reduced. First of all, what is this cash reserve ratio? See, these are reserve requirements. The banking system, the scheduled commercial bank, for example, has to maintain two reserves, the SLR and CRR. You know that, right? The statutory liquidity ratio and cash reserve ratio. Cash reserve ratio is the percentage of the NDTL. What is this NDTL? NDTL, the net demand and time liability. NDTL. NDTL is nothing but you can understand it as total deposits with the banking system, be it demand deposit or term deposit. What are demand deposits? Which you can withdraw on demand like saving account, etc. and what you keep in fixed deposit, etc., is a term deposit, right? So the aggregate of this NDTL, net demand and time liability, whatever deposits you have in all of these forms, out of that certain percentage, so percentage of NDTL has to be kept in the form of cash with the central bank, and this is known as CRR. Now changing CRR, okay, is a direct tool. Yes or no? Do you know this? The direct and indirect tools. So have you read this thing? CRR is a direct tool of monetary policy or indirect tool? Because it directly affects the systemic liquidity. So has a direct impact on the economy or the system liquidity, right? Say when CRR is cut down, what happens? What would be the implication? If CRR has been reduced, so the decision taken, I hope you have understood what is CRR, right? Certain percentage of NDTL to be kept in cash with the central bank. Now, if it has been reduced as it has been done by 50 basis points, 50 basis points it has been reduced, or 0.5%. Earlier it was 4.5, now it is 4% of the NDTL which you need to maintain. Fall in CRR would mean they need to keep less of these deposits in the form of CRR, which they cannot lend, the banks. Now if they need to keep reserves lesser than what they had to keep earlier, the banks will be having surplus amount to lend in the economy. Are you getting my point? Yes. So money available with the banking system will increase. Now liquidity will increase. Also, they can use this fund to lend in the economy. They can earn interest on that. Further sources of liquidity would increase. Why this has been provided? Because MPC is expecting certain risk can be there which can reduce the liquidity, although presently it is good, but then future expectations. I hope this is clear. That's why CRR has been reduced by 50 basis points. So presently it is 4% of the NDTL. Earlier it was 4.5% of the NDTL. And they have said that it is going to restore the liquidity in the system with this. And two tranches may in two 25 basis point tranches it will be implemented. Overall 50 basis point decline will be there, right? So fall in CRR or SLR directly increases the liquidity with the bank. That's why CRR is a direct tool. I hope you have understood. Remember, and this has been a question recently. So direct tool and the indirect tools. Yes, future expectation of capital outflow, tax outgo, capital volatility, depreciation of the currency, a lot of factors. Okay. Then next, what about the financial stability? So if you see the financial performance or the profitability indicators of NBFCs of banks, it is good. We have covered these things earlier in report section as well, like FSR and RBI annual report. The gross NPA, if you look at the GNPA, gross NPA. Okay, what is gross and net NPA? So gross NPA is basically when you do not separate the provision you make against the risky assets or risky loans. But when you separate those the amount of provision you have made against the risky loan, it gives you net NPA, right? So gross NPA ratio of the scheduled commercial bank, it has improved further and it was only 2.54% at the end of September 2024. So if you see GNPA for the scheduled commercial bank has been lowest since March 2011. That is a good indicator that the financial stability is restoring in the banking system. Also, the cases of delinquencies have been reducing. And further, to address the issue of the unclaimed deposits which are not claimed, right? Inoperative accounts and frozen accounts, pendency of accounts, etc. KYC norms have been updated. Also remember, RBI has been strictly following or observing the NBFC's lending, also bank lending to NBFCs. Whatever loan NBFCs are taking from bank is also under observance. Why? Because NBFC consumer loan segment or the retail loan segment has recently witnessed an uptick in the number of delinquencies or number of NPAs, right? So it has been strict on NBFC retail loan segment. That's why gradually you see credit growth coming from the NBFC loan segment is declining, and that's why becoming aligned with the deposit growth rate in India. We have covered this thing in the current affairs as well, right? So remember this, financial stability is improving. Bank ka GNPA is lowest since March 2011. That is quite good. Next, if you see the external sector, so in October 2024, India's merchandise exports, they grew by 17.2%. Okay. But imports, they rose by 3.6% to reach 66.2 billion. So basically, our merchandise, goods exports, they have grown, but imports have also grown. Overall, we still have merchandise trade deficit. This is the catch. Okay. So there is a widening of merchandise trade deficit. It has rather widened. It has widened. What is merchandise trade deficit? That we are exporting less and importing more. The goods only I'm talking about, not the services segment, right? It has widened to 27 billion US dollars in October month. Remember this. Now, this is not a good indicator. Then if you see why, because when you have trade deficit, there's a pressure on the forex reserves as well, right? Export creates demand in your export creates employment opportunity, production, economic opportunities in your country, because export is foreign demand of whatever is being produced in the domestic territory. Are you getting my point? So we need to do this thing. We need to correct this thing. Services mein, we are still having trade surplus as has been the trend, but merchandise trade deficit is widening for India. Then if we talk about foreign investments, what is the status of foreign investments? So the gross FDI, foreign direct investment, FDI inflows, they have grown by 25.6% in April, September. Okay. So FDI inflows into India have grown. That is good. That means we are having additional capital in terms of foreign capital. FDI is what? Foreign direct investment, which gives you ownership. So generally it is more than 10% ownership in the company as well. And you know that FDI is brownfield and greenfield as well. Brownfield, where you invest in already established, already there establishments which are already there. Greenfield mein, the project has started right from scratch. And when you require a lot of approvals and all, that is called as FDI coming from the approved route. And when it can be there without any prominent approval and documentation, it is automatic route. These are certain FDI classifications, right? So FDI inflows in India are improving. Then if you see the net FPI inflows to India, FPI, I have told you what is FPI, the foreign portfolio investors, investment into your financial securities market, right? It has also stood at $9.3 billion so far. And this has been mainly supported by inflows in the debt segment. The debt segment has been attracting FPI, or the debt raising instruments have been attracting FPI. Remember this trend. So the FPI inflow in India have been particularly increasing due to debt segment, or coming particularly into the debt segment. I hope it is clear, right? Or the debt raising instruments. Then we have the external commercial borrowings, ECBs, non-resident deposits, etc. All these are, are a part of capital account BOP, right? So we, in balance of payment, which records our transactions with the rest of the world, the balance of payment is is broadly divided into two categories: current account and capital account. Current account BOP records your trade activities, trade of goods, services, the invisibles, the transfer payments, etc. Capital account basically records whatever leads to change in ownership. Remember, like borrowing, like FDI, like FPI, right? So I'll just give you one example that would make you clear what is current and what is capital account. Say this person XYZ wants to buy a BMW car from outside India and buys it, imports it. That is a current account transaction. Now person becomes more rich and more ambitious, wants to buy the entire BMW company. That transaction will be recorded in capital account BOP. Why? Because it is changing the ownership of the company. Are you getting my point, everyone? Yes or no? This is the broad difference. So ECBs, external commercial borrowings, what our residents are borrowing, say, from abroad under the eligible routes, the NRI deposits, they all are recorded in the capital account BOP. So they have witnessed higher net inflows. That means we have borrowed the commercial borrowings of the residents of India from the eligible entities outside India have been higher. NRI deposits have been higher recently. Net inflows have been higher in these segments of capital account. Clear? Compared to the last year. Now, one very important thing, why you see, why we are saying that NRI deposits are increasing and we are attracting more of NRI deposits, there are reasons. So, in order to attract more of such foreign capital and capital inflows, this can be important. Recently, a decision has been taken and in MPC it has been decided to increase the interest rate ceilings on the FCNRB deposits. FCNRB deposits. What are these FCNRB deposits? See, NRIs के account के लिए you have different deposits के लिए you have different accounts, right? The ordinary residents, they have to maintain separate account and the NRIs maintain separate account. So the NRE accounts, NRO accounts, FCNRB accounts, these are categories of such accounts. FCNRB stands for foreign currency non-resident bank accounts, right? These are maintained in foreign currency. Now suppose there is a NRI, right, wants to, yes, there's an NRI wants to deposit his or her money in form of foreign currency in India in his or her account that can be deposited in FCNRB account that is maintained in the foreign currencies. In all currencies like US dollar, British pound, Japanese yen, Australian dollar, you can maintain these accounts. Yes, like Vostro and Nostro, yes, right? So this is the thing, FCNRB. Now, effective from today only, banks are now permitted to raise fresh FCNRB deposits of 1 year to less than 3 years maturity. 1 to less than 3 years of maturity at rates not exceeding the ceiling of overnight alternative reference rate plus 400 basis points as against 250 basis points. Now what is this? This is, I know, very technical, but let's try to understand. The catch was interest rates ceilings have been increased. Now the FCNRB accounts will attract more of interest in the deposits. First thing. How that interest rate is decided? It is based on something called ARR, alternative reference rate. Like in the money market segment or the interbank segment, we have reference rates, benchmark rates, right? Like earlier we had LIBOR, now replaced by SOFR. I have discussed this thing number of times with you. Secured overnight bank rate, right? Financing rate, secured overnight financing rate, SOFR. For India, you have the Mumbai Interbank Offered Rate. Yes, the MIFOR, the MIBID or MIBOR, right? Mumbai Interbank Forward Outright Rate or Mumbai Interbank Offered Rate. These are the benchmark rates on the basis of which the interbank transactions or interbank loans they are given, right? This is just to make you, just to give you a reference, not going in deep into that. Similarly, you have alternative reference rate, which is taken from the money market secured instruments. So it is also serving as a benchmark rate for all these purposes. What is the source of this rate? The money market instruments, particularly which are backed by the government, like the repo transactions, right? Which are secured transactions. Are you getting my point? So this earlier the interest was provided as ARR served to be the benchmark plus 250 basis points. Now it has been increased to ARR plus 400 basis points. So this is the revision. This is the revision. ARR or this benchmark rate plus 400 basis points. Tell me, is this clear? Quickly let me know so that I can proceed further. This is clear, right? Anyone? Clear? All right, very good. Now, so this is for 1 to 3 year of maturity. What about 3 to 5 years of maturity? 3 to 5 years of maturity, it will be ARR plus 500 basis points. This is the revision. So this much interest ceiling will be there. It will attract more of NRI deposits, isn't it? Because incentives to deposit have increased. So we will have more of foreign inflow. These decisions have been there. Remember, 1 to 3 की maturity में ARR plus 400 basis points and 3 to 5 years की maturity में ARR plus 500 basis points. It is going to attract a lot of NRI deposits in foreign currency. So we are going to have a lot of foreign currency. That is the thing. Good decision, isn't it? Right? So this is the catch. Now next thing is additional measures. This was about foreign stability, external sector, GDP, inflation, etc. You know that in MPC, they also announced some additional measures for the overall betterment of the economy and different sectors in the economy. What all are the additional decisions they have taken or measures they have taken, right? First thing, expanding the reach of Forex retail platform. They have decided to expand the reach of Forex retail platform. Now, what is this platform and how this reach will be expanded? Forex retail platform, if you see, it was launched in 2019. This platform basically provides you buying and selling of Forex or foreign currency for converting the currencies, right? So this is the retail platform where you can convert the currencies, you can buy and sell the foreign currency. So this is Forex retail platform. Now that is very much important for more of current account and BOP account transactions, right? And convertibility as well. Yes or no? So this, they are trying to expand the reach. How? They are trying to connect this Forex retail platform. Since launching year is mentioned specifically in the governor's statement or the MPC highlight, remember 2019, it can be important, right? They are now proposing to link it with the Bharat Connect platform of NPCI. With the, okay, just give me a second. With the Bharat Connect platform of the NPCI. Now, you will understand the importance of this news once you know what is this Bharat Connect platform. What is Bharat Connect platform? Bharat Connect platform, maintained by NPCI, the National Payment Corporation of India, it was launched to make bill payments easier. So it is one-stop solution for all the bill payments across geographies, right? So this is not only for person residing in India. Across geographies, you can access this for your bill payments. This is Bharat Connect, connecting them with the world in terms of bill payments, right? Also, this is the first time that RBI has allowed on this platform the buying and selling of US dollars as well, if you remember that. So there's a pilot project in this where you can also purchase the US dollars against rupee. So Bharat Connect is a bill payment platform broadly. Now once this Forex retail platform gets connected with Bharat Connect, it will be expanded further. This is the thing. Okay. And this would enable users to transact on the FX retail platform through their mobile apps of the banks or non-bank payment system providers. Either way they can use this. It will expand the reach of the FX retail platform, okay, and it will promote fairness and transparency in pricing etc. So you need not go into so much technicality. You just need to understand what is this Forex retail platform, and connecting this with the Bharat Connect would expand the reach of this Forex retail. I hope it is clear, everyone. Yes or no? Yes? Yes or no? Clear? Very good. All right. Then next what we have is introduction of secured overnight rupee rate. Now this is going to be very much significant. SORR, a benchmark based on the secured money market. So like presently, what do you have? Which benchmark? Okay, tell me who launches these or who introduces these benchmarks in India? FBIL, right? Who monitors these benchmarks? FBIL, Financial Benchmarks of India Limited. Yes or no? FBIL. So they are planning to launch this SORR, Secured Overnight Rupee Rate. Like you have the SOFR. What is SOFR? So earlier, just understand in a simple way, what used to be the case is London-based interbank offered rate, LIBOR, used to serve as a global benchmark. Generally, every country used to refer to LIBOR for deciding their own benchmark for the interbank transactions. But then with LIBOR, there were certain transparency issues which were highlighted. It has now been replaced, LIBOR has been replaced by SOFR, Secured Overnight Financing Rate, right? Which is decided on the basis of US dollar denominated securities, US government securities, right? SOFR. SOFR ke basis pe then we decide our Mumbai Interbank offered rate, right? MIBOR, which basically, or say Mumbai Interbank forward outright rate. So FBIL decides this benchmark for India, and that serves as a benchmark, or that serves as a reference for your interbank transactions. Are you getting this point? Or money market instruments. Now in that case, they are trying to create a new benchmark, the secured overnight rupee rate. It will be called as. It will be based on secured money market instruments. On that basis, it will be decided. Okay. With this thing, they are trying to further develop the interest rate derivatives market in India and then improve the credibility of the interest rate benchmarks. The SORR will be there, particularly based on secured money market instruments, overnight market repo, the TREPs, etc. So particularly, it will be decided on your on the basis of your secured money market instruments, particularly the overnight market repo transactions. So let's see, when it gets implemented gradually, the further details will be out. And if it is there in CA, we will discuss them in CA accordingly. I hope whatever I have discussed so far is clear. Everyone, tell me yes or no. Yes. Yes, all right. Then next thing they have announced is Connect to Regulate. Connect to Regulate, an initiative for open regulation. Connect to Regulate. So as a part of their consultative approach in framing the regulations, this is a program, Connect to Regulate. It is going to be there, launched under the ongoing program of RBI at the rate 90 commemorative events. Okay. Now this platform will invite various stakeholders to come and share their innovative ideas regarding the banking sector regulation, right? These stakeholders, associated stakeholders. So it is going to provide them a platform It is going to provide them a website. Okay, this is going to be a section in RBI's website. So it's going to be a platform on the website itself available for the stakeholders to share their ideas, their inputs on specific topics. So this is inviting more participation. That's why connect to regulate. I hope you understood that, right? This is the thing. Connect to regulate. Remember, this is a program or initiative of RBI, connect to regulator, decided by MPC. Then introduction of podcast facility. Podcasts are going viral everywhere, isn't it? Everyone is trying to earn through podcasts. So you see, podcast is something which RBI also wants to delve into, right? So podcast, introduction of podcast facility as an additional medium of communication, because now people find it more engaging as well. So it is a better way to connect with the people, with the stakeholders, with the media, with the economy, basically via the podcast. Now over the years, RBI has expanded its communication toolkit and techniques, right, to enhance the transparency and better connect with the people. Similarly, in line with that, it is going to add a section of podcasts to it to communicate basically with further stakeholders in public and disseminate its decisions, its ideas, its information more effectively. So podcast is going to be there. Then in further additional measures, we have collateral free loan, agricultural loan, enhancement of the limit. So the MPC has also decided that the limit for collateral free agriculture loan, which was last revised in 2019. Now since the okay, you see, taking into account the rise in agricultural input cost and overall inflation, agriculture input cost is rising, right? Machineries, equipments, they are costlier. So input cost is rising, inflation is also rising. So there's a pressure on the pocket of the farmer, particularly the small and marginal farmers. We need to provide them more of financial assistance in terms of loan. Also, collateral free loan would be better because a lot of them do not have enough collateral to provide to the banks. That's why they go to non-institutional channels of lending and then they fall prey to it, prey to the trap. Getting my point, right? So they have decided to increase the limit for such collateral free agricultural loan from existing 1.6 lakh rupees to 2 lakh per borrower. That is a good initiative. So collateral free agricultural loan limit has been raised to 2 lakh rupee per borrower. It is going to enhance credit availability for small and marginal farmers and expand their capacity of agricultural production and farm activities, right? This is very significant decision. Then pre-sanctioned credit lines through UPI. Now they also want to extend the scope to small finance banks. What is this? The credit line on UPI, it was launched in September 2023, where you can avail credit line via UPI. What is a credit line and difference between a loan and a credit line? Credit line is like a credit card, right? You can access it number of times until you exhaust the limit. Loan is one time withdrawal and then you have to pay back on the entire amount, no matter number of times you have used it, how much of that fund you have used it, right? So this is the difference. So this program of credit line on UPI, it was launched in September 23 and was made available through your scheduled commercial banks. They have now decided to permit small finance banks also to extend these credit lines through UPI. This is going to be very important. Remember this. So this is expanding the capacities of the small finance bank and financial inclusion. Now a small finance bank will be eligible to provide these credit lines via UPI apart from the scheduled commercial banks. So it is going to deepen financial inclusion process in India, isn't it? Right? This is the thing. And enhance formal credit, because the small finance banks ki reach is different than the other banks. They can also reach out to the small number of customers or small customers which are not the, say, customer base of the other banks or the scheduled commercial banks. So it can reach out to it can increase your last mile delivery of the loans. It can reach to remote areas, small finance banks, and then it can improve your credit penetration into the economy, then improving your financial inclusion. Okay. Then framework for responsible and ethical enablement of artificial intelligence, pre-AI. Remember, pre-AI in the financial sector. They want to set up a committee to implement this thing, free AI. Now you also need to remember the full form of free AI. They can ask you, what is the full form? Framework for responsible and ethical enablement of artificial intelligence. Again, I am repeating, framework for responsible and ethical enablement of artificial intelligence, free AI. Because financial sector is witnessing a rapid transformation, UPI is expanding at another levels, right? We need to secure it. Also, we need to integrate it with the latest technologies. So that's why, because of this rapid transformation enabled by technologies such as AI, tokenization, cloud computing, etc., in order to harness the benefits of these technologies, at the same time making these financial transactions more secured, financial products, banking products, product line more secured, the MPC has decided to set up a committee which will be comprising representatives from a diverse range of field to give suggestion on the implementation and recommend a framework to enforce this free AI in the financial sector. I hope it is clear, right? Then AI solutions to identify the mule bank accounts. So they have come up with AI solution called as mulehunter.ai. Remember this, mulehunter.ai. It is going to be their AI solution to identify the mule bank account. What are these bank accounts? These are basically suspicious bank accounts which are used for suspicious transactions, like for rotating the or round tripping of the black money. The money laundering activities, in money laundering based activities, they activate these accounts. You don't know about the owner of the account, about the real identity of the owner of the account or the account holder. So these are suspicious accounts. To track or to find out, to identify such bank accounts and reduce their numbers and malpractices associated with them, they have come up, the MPC has come up with AI based solution which is mulehunter.ai, okay, to mitigate and prevent digital frauds as well. Also remember, it has been developed by RBI Innovation Hub. This is a probable question I am telling you in all the upcoming examination. Write down this question separately, that who has developed this mulehunter.ai platform. Remember RBI Innovation Hub. It can be a probable question, right? It will help in identification of such accounts and then mitigating the digital or financial fraud. These were the additional measures undertaken by MPC. At the end, in the governor statement, if you see, governor has concluded the statement with a positive note, highlighting the growing importance of India in the global economic scenario. Also giving a positive tone to India's future economic growth prospect, right? And then the governor has ended the statement with this quote. So I would like to discuss this with it. Never lose your faith in the destiny of India. This is of Netaji Subhash Chandra Bose, right? Never lose your faith in the destiny of India. So this is the thing. They are very hopeful for India's bright future, bright destiny. I have discussed all the important decisions taken in recent MPC Monetary Policy Committee meeting with you. Further, in the additional measures which we have discussed, as with the passage of time, they will be implemented. Further details on them will be out and we will be discussing them. So you need not worry about that. Otherwise, I hope whatever I have discussed is very much clear. simultaneously with the important facts, projections, performances and decisions. I have tried to discuss all the basic concepts. So if even you are new to this concept and this examination, this competition and this field, it becomes easier for you to comprehend. Now we have a question from Satyen. You have purchased this course today. Any suggestion on how to cover the missed lectures? You will be provided with the missed lectures, right? Okay, so if you have this exam lining up recently, so we have a good amount of time for other examinations, right? Satyen. So you can start preparing after that. If you are keeping this exam as a priority, you should focus upon that, and after that you should try to cover up the remaining lectures. But I would suggest don't pile up the current affairs, because current affairs, once they become obsolete, you find it difficult to retain so much of facts, right? That would be my suggestion. Static part you can do later on, but at least try to manage CA with your further preparation. So that was it for MPC highlights. If you have any other doubts, you can ask me. I'm open to doubts. Yes, anyone? Any questions? Any doubts? Any suggestions for the interview candidates? Okay, for topics other than MPC meeting from banking sector, which can be asked. Yes, see, banking sector mein one thing which I would say, you are appearing in any interview, okay? UPI based figures and recent developments. UPI based developments. Also, AI based developments in the banking sector. Also, financial new technologies or AI based tools adopted by banks. Particularly, apart from that, I think the conventions recently, agreements signed by banks for AI, for green or sustainable projects, providing finances to such projects can also be one important area. Plus all these RBI schemes, plus any initiative for digitalization in the banking system, any new step towards financial inclusion. These are the prominent areas which I can suggest you. Nikhil. All right. Anything else? Anything else, or is it clear? All right then. Thank you so much for staying tuned in the class. I hope you find it useful. Thank you so much. See you in the next session. Till then, have a great day.